Stock markets have been tumbling and President Trump is blaming the Federal Reserve. He says the Fed's gone crazy raising short-term interest rates. Higher interest rates, not only do they spook investors, but they also make it harder and more costly to finance a rising budget deficit. So why is the Fed doing this? Here's 3 reasons. First of all, inflation has gotten back to the Fed's 2% target after running below it for most of this expansion. With inflation back at the Fed's target, it stands to reason that interest rates should also be getting back to normal. The Fed kept them near zero while inflation was running below target, and now it's trying to get interest rates back towards around 3% on the short end. They're getting closer to 5% for mortgage rates. The other reason is unemployment. The unemployment rate hit 3.7% in September. Low unemployment is a great thing for workers and for the economy, but we tend to see bad things happening when it gets too low. We've had outbreaks of inflation or sometimes financial bubbles when it gets too low, and the Fed wants to make sure that the economy doesn't overheat. Raising interest rates do that, so that's another reason why they've been pushing them higher. The third reason is that growth has picked up. Growth was near 2% for most of this expansion. It's now closer to 3% on a year-on-year basis. What does that mean? It means a stronger economy can bear higher interest rates. So the Fed thinks that what it's doing is justified by the economy and that it hasn't, as the president said, gone loco.